Hello friends, welcome to my channel Financial Fitness with CA Ashima Abel Yunus and to this video which is part 5 in the series of videos on Double Taxation Avoidance Agreement, commonly known as DTAA. Double taxation is attracted when a non-resident is liable to tax in the country of his residence on the worldwide income as well as in the source country on the income accruing or arising in that source country. But double taxation avoidance agreements are in place between countries to avoid levying taxes twice on the same income. To know more about international taxation and how to avail the benefits that comes with double taxation avoidance agreements, you can watch part 1, 2, 3 and 4 of this videos in this series on double taxation avoidance agreements. In this video, I will cover the remaining FAQs, which are frequently asked questions on the applicability of double taxation avoidance agreements, like on what type of income DTAA is applicable, what are the steps to determine how to apply double taxation avoidance agreements, is DTAA applicable on GST, and requirements to file Form 67. So make sure you watch this video to the end. To understand the basics of international taxation and double taxation avoidance agreements, you can watch my previous videos, which are part 1, 2, 3, and 4 in the series on DTAA. You will find the links to those videos in the description box below, as well as in the I buttons above and towards the end screen of this video. But before we begin, I would request you all to please subscribe to my YouTube channel. It's totally free. You can just log in on YouTube with your email ID and click on the subscribe icon and share it with your family and friends. You can also share it in the WhatsApp groups in your phones. I will just take a quick pause only for 5 seconds so you all can take time to click on subscribe icon, like icon, and also click on the bell icon that you will find below this video. Please do that while I wait. Okay, so now I'll quickly introduce myself for the new viewers. Here I am, CA Ashima, a professionally qualified chartered accountant, a certified auditor, and a certified ERP implementation specialist, specializing in tax, finance, IT, and audits. I have worked as a partner and a director with one of the top 25 leading CA firms in India, which has also been a member firm of one of the big fours. After working in India for a period of 10 years, I moved to Sweden and have also worked as a senior financial consultant with a multinational and catered to clients in Sweden, Finland, Norway, Denmark, and the UK. I have also worked as a freelance financial consultant. As explained in my previous videos, double taxation is a tax principle referring to income taxes paid twice on the same source of income. It can occur when income is taxed at both the source country and the country of residence. Double taxation avoidance agreement is executed by two countries to mitigate the double or larger tax in the given situation and also to promote and foster economic trade and investment between the two countries. Now let's understand on what type of incomes DTAA is applicable. Double taxation avoidance agreement specifies the rules for taxation of income by the source country and the residence country. Such rules are for various categories of income like salary, interest, dividend, remuneration, business, capital gains, etc. The income on which an NRI can claim tax exemption or tax credit will be mentioned in the DTA with the resident country. The provisions of DTAA are not the same for all countries. So, first, you need to refer to the DTAA that will be applicable in your case, depending on which country you reside in and from where you derive your income. Now let's understand what are the steps to determine how to apply DTAA. Step 1 is tax liability as per Income Tax Act. First of all, you need to find out the type of income on which double taxation avoidance agreement applies and its tax liability under the Indian Income Tax Act. Second step is to calculate the tax liability under the double taxation avoidance agreement. If the income falls under specific articles of double taxation avoidance agreement, then the income will be taxed as per those articles. Third step is to finalize the tax liability. Using section 90 subsection 2, decide which is more advantageous between the IT Act and double taxation avoidance agreement where treaty will override. You may also note that if the non-resident or foreign company has a PE, which is permanent establishment in India, then general articles for taxation would apply. Now let's understand whether DTA is applicable on GST. GST is an indirect tax on the consumption of goods and services, whereas the purpose of double taxation avoidance agreement is to avoid double taxation of income tax for taxpayers earning income in two different countries. However, in certain cases, if the supply of goods is between India and another country, GST may apply, and so might the indirect taxes of the other country. This will lead to double taxation. However, whether or not a DTAA is applicable to GST purely depends on the specific details of that double taxation avoidance agreement. But as of now, there is no double taxation avoidance agreement that extends to GST. Now let's understand what is Form 67. Form 67 is a statement or a form which is required to be submitted by the taxpayer to claim foreign tax credit. It needs to be filed in the income tax e-filing portal if the taxpayer is claiming foreign tax credit. It's important to note that Form 67 has to be filed before the e-filing of the income tax return. A digital signature certificate or electronic verification code is mandatory to submit Form 67. But if you have not submitted Form 67 before the due date of filing of the tax return, then the Income Tax Department might disallow your foreign tax credit, and you might have to file an appeal with the CIT appeals, or the case might have to go up to Income Tax Appellate Tribunal, which is known as ITAT, for allowance of your foreign tax credit, for which reference can be made to a few case laws. One is Ms. Brinda Ramakrishna versus ITO, and to another case, a recent case of Sonakshi Sinha versus CIT, which is from ITAT Mumbai, where it was held by the ITAT that foreign tax credit cannot be disallowed in case of not filing of Form 67 or delay in filing of Form 67 prescribed under Rule 128 of Income Tax Rules 1962. Thus, by this observation, ITAT, which is Income Tax Appellate Tribunal, have not denied the substantive benefit in case of procedural lapse. So the crux is that foreign tax credit cannot be disallowed just because Form 67 was not filed within the due date. However, it is advisable to file Form 67 within the due date, that is, before filing your income tax return, in order to avoid the hassle of getting into litigation with the Income Tax Department. So friends, this was part 5 of the series on double taxation avoidance agreements. To know more about other FAQs on DTAAs, you can watch my other videos on this topic. You can also watch other videos where I have shared information about the tax benefits for returning NRIs that comes with RNOR tax status and other tax benefits for NRIs on sale of a house property in India, and many other videos related to financial planning and investments, which are not only relevant for NRIs but for all others as well. So friends, now it's time to wrap up this video, and I hope you all will benefit with the information shared in this video. If you find it useful, then please make sure you click on the like icon, and please do subscribe right now if you haven't done that yet. You just need to log in with your email ID on YouTube to subscribe. That's it. It's totally free for all. So do it right now. Subscribe, like, and share. Share it with your family and friends, and do share it in the WhatsApp groups in your phones as well. Thank you and bye-bye.